Capital structure is a mix of the short-term and long-term funding the business has. And you're right, that could be a mixture of debt and equity. But I think looking at the short term, I tend to think of capital as being the working capital of the business, so the stock, the debtors, the creditors, and the cash funding or debt funding of short-term nature in the business. So it might be the overdraft facility or a CRD facility or the cash that's in the business. And the longer term position, that you can have longer term debt, for example, in the capital of the business. So it might be a term loan or some other sort of long-term loan, or actually equity funding itself as well. So that could be investment within the company or retained profits, as you talked about. And I think what's always really important for businesses is to get the right mix of capital, both in terms of the duration of that capital, the length of it, and also the nature of it as well.
So let's just touch on this. Capital structure is something that lots of advisors and finance directors are talking about at the moment. Why does it matter in particular right now?
Yeah, well, we're about to head into a challenging economic environment, and actually having the right capital in the business is what's going to make a difference to businesses, whether they survive and flourish or whether they struggle. And if we look back at previous recessions, what we'll often see is that businesses tend to fail on the way out of a recession as opposed to on the way into it. And that's really because of the capital structure that they have and having the wrong capital structure. And a good example of which was Lehman's. It had lots of assets, but not the right type of assets. And when the banking markets froze up, it couldn't get hold of the cash and liquidity to enable it to satisfy its payments that were required.
So if we then make that example sort of real for our clients, what we see is that sometimes our clients might have the wrong mix of capital in their business at a given moment in time, which makes, if you like, continuing to trade particularly challenging. Is that kind of the direction you're saying this is going in?
Yeah, and actually, if you look at where we are in the cycle at the moment, the economic cycle, what you'll probably find is that lots of businesses have managed to generate cash during this difficult period. There's been furlough payments and bounce back loans, which have enabled short-term capital, cash positions, actually to do pretty well in corporates. Now, as we head towards a downturn, some of that cash will be utilised on funding of potentially losses in businesses or more difficult trading times. And that will therefore be a sort of a shorter term funding to plug really what is probably more of an equity hole in businesses, and the gaps created really is sort of from equity positions. As we come out of the economic cycle and start to grow again, the cash won't be there to fund growth in the business and to fund the working capital required to grow the business. And that's where we see businesses struggling, actually.
So it sort of sounds then that cash is almost, not all cash is equal. So the cash that a business just generates, that just throws off, that's great, and that goes into retained profit. However, that's really hard to forecast at the moment. So not all businesses know how much of that they're going to have, especially as Brexit might change trading conditions further and currency and supply chain. You've then got cash which has got IOUs on it to the bank, and some of those IOUs are quite friendly if they're like CBILS loans IOUs, and some of them are a bit harsher if they're kind of bridge funding. And then you've got really, really long-term IOUs, effectively from equity funders, who have sort of said, look, I'm in this perhaps for a capital gain or a risky bit of income, and they might be willing to wait a bit longer. And I suppose what we're talking about here is really getting that priorities of cash wrong can cause some pretty serious consequences as somebody comes out of a difficult period.
Yeah, we definitely see a mismatch. So this mismatch between the use of the cash and what its purpose is for. A good example is where people have taken on short-term debt really to fund longer-term positions. So we see lots of management buyouts that were funded through CRD facilities or overdrafts, and that's great while trading is good. But as soon as trading starts to slow down, you've got a repayment of those facilities. But actually, the purpose for which they've been set up is to fund the purchase of equity. and therefore the repayment of those facilities can't be enabled because the assets that reside or that have been invested in are actually longer term assets. And that's where we get this problem, this mismatch between actually that cash and use of cash.
Yeah, I think that's quite interesting. We did a webinar and Richard Vass commented on, Richard Vass, one of the partners at Price Bailey, he commented on fair value and how that can be an increasingly challenging concept for businesses, especially given their audit requirements in the future under COVID and in a post-Brexit environment as well. And I think where some of these assets have really been critical to the leverage that they've then taken, there could be some troubling times ahead. I don't see too many upsides on that equation coming forward.
Yeah, what's important, I think, at this stage is for businesses to look at the assets and look at the capital structure and make sure they get the right balance. There is a temptation, I think, for companies to hold back on really sort of plugging that longer term problem with equity, which is what really in a lot of businesses is required. And what you might get, I think, finance directors jumping up and down and, saying, demonstrating to the board that there needs to be some equity funding. Quite often we see owners reluctant to give up part of the business because they think that in the short term, stretching creditors, for example, might be the easier thing to do to fill that hole. The challenge is in the longer term, as businesses start to grow, if you've already got a stretched creditors position, you've got nowhere to go to fund that growth in the business. You end up with an over trading position, and that's where we start to see the problems. So I think the key for me is that really start to look early at equity and the options that gives you, so that when you start to come out of recession, you've got the options available to you to really sort of go for that growth spurt that others may not have.
Yeah, I think this is the critical thing. We the banks, the private equity and venture capital trusts we work with, we're all expecting to see more transactions next calendar year, and there's bound to be an increased emphasis on equity funding. I think all of us are a bit worried though that next year's too late for many of these businesses to get ready, and I think you said earlier, Phil, that the best time to sell shares in your business is when you don't need to. So maybe now is the right time to be preparing for those sorts of transactions, especially if there isn't enough headroom to make the kind of operational strategic changes in a business that really need to be made in a post-COVID trading environment.
Yeah, it's definitely the case. I mean, going to the market when you don't have to will give you more options. It'll give you choice. You can afford to turn down things that don't seem the most appropriate or the best. I think if you go to market too late, you could be one of a large number. And I think equally, you could be forced down a tunnel of taking an option maybe that is just inappropriate for the business, is very expensive, is too short-term in its nature, and doesn't really actually give you the best outcome in the longer term.
So I guess to wrap up, what we're really saying is plan your capital structure, the sources and uses properly. Listen to your FD, and because often they are the ones sort of waving the flag on this, but the short term can sometimes take priority over the long term in the minds of some of the other directors on the board. And if you're going to raise equity funding, try and get ahead of that curve and get ahead of the race and do it sooner rather than later, so you've got more choices.
Yeah, it's definitely the case. I mean, I think now obviously people will be challenged around their business and what's been happening, what forecast profits look like. So there are some challenges around raising equity, but there's still a lot of money out there. It's a good time to go and raise money from these providers. And I think if you can get the right plan in place and you can demonstrate what the profitability is outside of the current environment, then actually, this is as good a time as any to go and raise equity. And we know that there are lots of providers out there that are hungry to invest in the right businesses.